Hello and welcome to the Investing Fuse. In this video, we're going to learn how stock dividends affect the stock price. The lessons contained in this video include what stock dividends are, examples of stock dividends, market perception of dividends, the dividend declaration date, what the ex-dividend date is, the dividend yield and payout ratio, and how dividends are paid out. Let's go ahead and get started. So how do dividends actually affect the stock price? Dividends can affect the price of a stock in a few unique ways. While the overall dividend history of a given stock plays a general role in its popularity, the declaration and payment of dividends has specific and predictable effects on the price of stocks. Before we go any further, let's first take a look at how dividends work in the first place. For investors, dividends serve as a popular source of investment income. For the company issuing the dividends, they are a way to redistribute profits to shareholders as a means for thanking them for their support and in order to encourage additional investment. Dividends can also serve as an announcement of a company's success. Because dividends are issued from a company's retained earnings, only companies that are substantially profitable tend to issue dividends with any sort of consistency. Dividends are generally paid out in cash, but they can also be issued in the form of additional share stock. Now let's take a look at an example of stock dividend in order to get a better idea of how they work. Let's assume a company has 1 million shares outstanding and decides to declare a 50-cent dividend. An investor holding 100 shares in this instance would receive $50, and the company would pay out a total of $500,000 in stock dividends. If the company instead issued a 10% stock dividend, the same investor would receive 10 additional shares, and the company would distribute out 100,000 new shares in total. As an investor, it's important to know how your dividends will actually be distributed out to you, either in cash or as additional shares, because some investors do rely on dividends as an additional source of income. Stocks that pay consistent dividends are generally considered popular and stable amongst investors. Although dividends are not guaranteed, companies try to maximize shareholder value by issuing consistent dividends. It's worth noting that dividends are subject to change based on decisions made by management and overall economic conditions. When public companies showcase consistent dividend histories, they become more attractive for value investors. If a company announces a higher than normal dividend, public sentiment tends to soar towards that investment. On the contrary, if a company decides to reduce its dividends, it may cause lower public sentiment and have a negative impact on the price of a stock. The truth could be that the company's retained earnings are being used for other purposes, such as funding expansions, but the market perception of the situation is always more powerful than what's actually going on underneath. So now let's take a look at what a dividend declaration and ex-dividend dates are and what kind of role and impact they have when it comes to the price of a stock. Now, before a dividend is paid out to investors, the company must first declare the dividend amount and the date when it will be paid. The declaration of a dividend naturally encourages investors to purchase the stock. The company will also announce the last date when shares can be purchased in order to be able to receive dividends when they are paid out. This date is referred to as the ex-dividend date, and it tends to be 1 business day before the date of record, which is the date when a company reviews its list of qualifying shareholders. The public declaration of a dividend usually encourages investors to purchase the stock in order to receive a dividend. Since investors know that they will receive a dividend if they buy the stock before the ex-dividend date, they are willing to pay a premium. Following the declaration of a dividend, stock prices generally tend to increase in the days leading up to the ex-dividend date, although this isn't always the case. On the ex-dividend date, however, the price of the stock tends to drop by the amount of the dividend to account for the fact that new investors are not eligible to receive dividends and are therefore unwilling to pay a premium. This is because a stock dividend increases the number of shares outstanding, while the value of the company remains the same, and it dilutes the book value per common shares. And as a result, the stock price is reduced accordingly by the dividend amount. It's worth noting, however, that if investors are more optimistic about the stock leading up to the ex-dividend date, the price may increase larger than the actual dividend amount, resulting in a net increase despite the automatic dividend reduction. If the dividend is small, the reduction may even go unnoticed due to the back and forth of normal trading. Now let's take a look at how the dividend yield and the payout ratio work. The dividend yield shows the annual return per share that an investor realizes from a cash dividend payment, or the dividend investment return per dollar invested. The dividend yield is calculated by taking the annual dividends per share and dividing it over the price per share. It provides investors a good measure to use to compare dividend income from their current holdings to potential dividend income available through investing in alternative assets or equities. As an investor, it's important to note that an increase in the stock price reduces the dividend yield ratio even though the investment return from owning the stock and receiving a dividend has improved. A drop in the price of the stock can also show a higher dividend yield, but may indicate that the company is performing less than before and lead to an overall lower investment return. Understanding this relationship between the stock price and the dividend yield is important in order to understand the value of your investment yield. As such, the dividend payout ratio is considered a more accurate statistic by investors for evaluating a company's financial condition and impact on your overall investment return. The dividend payout ratio is calculated by taking the total dividends over the net income of the company. The dividend payout ratio reveals the percentage of net income a company is paying out in the form of dividends. If the dividend payout ratio is very high, it may indicate that a company will not be able to sustain such high dividend payouts in the future because the company is using a smaller percentage of earnings to reinvest in company growth. As such, a stable dividend payout ratio is preferred over an extremely high one. A good way to determine if a company's dividend payout ratio is a reasonable one is to compare the ratio of that to a similar company in a similar industry. Now let's take a look at an example of how dividends can be paid out. Dividends are paid out in one of two ways: a cash dividend or additional shares of stock, and in some rare cases, a combination of both. With a cash dividend, when a dividend is paid out, the company pays each shareholder a specific dollar amount according to the number of shares they already own. A company that declares a $1 dividend therefore pays $1,000 to a shareholder who owns 1,000 shares. In the cases of a stock dividend, shareholders are issued additional shares according to their current ownership stake. If the company in the above example issued a 10% stock dividend instead, the shareholder would receive an additional 100 shares. Some companies offer shareholders the option of reinvesting their cash dividends by purchasing additional shares of stock at a reduced price. If you enjoyed this video, please make sure to smash that subscribe button. Until next time.